Welcome to this month's Market Update. I'm joined today by Casey Lowe, Senior Consultant with Frontier Advisors Capital Markets and Asset Allocation Team. Hi Casey.
Wayne?
So been quite a lot of central bank activity of late. Can you step us through some of the repercussions of that?
So interest rates around the world are still increasing, particularly across a number of developed economies. If we start off with the US, which is probably the most important one, Jerome Powell, who's the US Federal Reserve Chair, made a much anticipated speech at an economics conference in Jackson Hole. And in that speech, he talked about how the cash rate, the interest rates in the US will likely stay high for some time, just so that they can bring inflation down to a more sustainable level. So that spooked investors, and as a result of that, equity markets finished the month lower. So that's in the US. In Europe, the European Central Bank has also been increasing interest rates, so by 0.75% at the latest meeting. And the reasoning behind that is because inflation in Europe is around 9% right now, so very high levels. And the main driver for that is because of the Ukraine war that's been happening. So that's been pushing up both food and energy prices, particularly gas prices. Closer to home, the Reserve Bank of New Zealand has also been hiking interest rates. They've actually hiked for 7 consecutive times now. So their cash rate is at 3%. And then domestically with the Reserve Bank of Australia, they've hiked again by another 50 basis points, by another 0.5%. So our cash rate here now is at 2.35%. And if you just look back at recent history, our cash rate has increased by 2.25% over a matter of just 4 months. So quite a steep increase over quite a short amount of time there. But following on that rate increase, Philip Lowe, the governor of the Reserve Bank, made a speech. And in that speech, it seems that they may actually start to slow down the pace of the hiking process now. The reasoning behind that is because they've hiked the interest rate by quite a large margin already. And usually there's a lag in the impact between higher cash rates and its impact on the economy. So the Reserve Bank most likely wants to assess the impact first before hiking much more aggressive from then on. So the Commonwealth Bank of Australia has actually done some analysis on this. Usually there's about a 3-month lag between increases in the cash rate and its impact on households. So I think the Reserve Bank may slow down a bit just to see what's happening to the economy.
So just picking up on that point with the Reserve Bank increasing cash rates, talking about households, are households the primary target of the Reserve Bank's activity there?
Yes, that's right. Cash rate is quite a blunt instrument. It impacts the whole economy, but when the Reserve Bank are changing the cash rate, usually the main target is the households. The idea behind that is that the increase in interest rates will have a flow-on impact on mortgage repayments. So higher the cash rate, the higher the mortgage repayment, and that should reduce the amount of disposable income that households can spend. So consumption will likely reduce, and hopefully that flows through to lower inflation. So that's sort of the main concept behind it. But just as there's no one national property market, there's no one average Australian household. There's households are at different levels of indebtedness, levels of income, and at different stages of repaying their mortgage. So there's some analysis from, again, the Commonwealth Bank of Australia when you look at their financial year results. It's very good in terms of seeing different profiles of households, and the results from the CBA are pretty good in this sense because they account for about a quarter of the mortgage market, so it gives you a pretty good idea on the national level. So in that analysis, about a third of households in Australia currently are about 2 years ahead on their mortgage repayments. So in our view, this group of households are less likely to be impacted or less likely to feel stress from higher interest rates. But there's a bit of barbell in the distributions of households. So you have a third which are less vulnerable, but there's a third of households which are less than a month in advance in their mortgage repayments. So in our view, this group of households are more likely to face financial stress with higher interest rates. So there are some risks there for Australian households as interest rates increase. But to finish on a positive note, when we look at the amount of savings that households have, current savings across households are at quite a high level, particularly compared to pre-pandemic levels. So that should provide some buffer as interest rates increase.
Plenty to consider, and it'll be interesting to watch that thematic work its way through over the next couple of months into investment markets. Thanks, KC, and thanks for watching this month's Market Update.